Good morning, ladies and gentlemen. On behalf of all of us at SKP, it is my pleasure and privilege to welcome you to this financial results conference call of Texmaco Rails and Engineering Limited. We have with us Mr. Indrajit Mukherjee, Managing Director, along with his colleagues, Mr. A.K. Vijay, Executive Director Finance, Mr. Hemant Bhuwania, VP Corporate Finance, and Mr. Ravi Verma, GM Corporate Affairs and Company Secretary. We will have the opening remarks from Mr. Vijay, followed by a question and answer session. Over to you, Mr. Vijay, for your opening remarks. Thank you.
Thanks, Naveen. And good morning to all the investors, all the investing fraternity who have shown interest in the company. We have been interacting with you regularly. Of course, maybe during the last year when the pandemic was there, our interaction has been slightly low. But then since we never expected that the pandemic will come back in such a manner whereby again we will be totally working from home and it will come down to lockdown to the states. But then, of course, this is a way of life we understood, and accordingly now we are gearing up ourselves, irrespective of the situation which is there in this. We are able to float and make some headway. And that's what basically we are trying to do in this company also. So with this opening remark, I'd like basically first to present you what the results have been. And thereafter, I'll give you a brief commentary on how the company is basically done in the past year. And then I'll open the session for the question answer, which will be very happy to reply to all of your queries. So as the results you have already seen in your hands, we have gradually after the pandemic and epidemic that is this COVID-19 caused, and thereafter another disaster which came in the form of Amphan in this region of country. And as a result, that thing, especially the Kolkata region suffered very badly. We have been able to perform reasonably well from second half of quarter two. First half was total washout. Second half, first few months, we could do just nothing. From the third month onwards, we started gearing up ourselves. And if you see the performance in the quarter 2, 3, and 4, we have gradually climbed up. So that is the target we thought of maintaining this year also, from quarter 4 to quarter 1 and accordingly maintain the year. But quarter 1 again is a disaster for the reason that we are under complete lockdown. The plants are not allowed to be operated. The major issue which arose and which any engineering company has to face, and they have to really come out with some very innovative solutions on that, is we have not been provided with any oxygen. And to an engineering company to run without an oxygen, especially both my foundry as well as my fabrication shops, it's a nightmare. We are trying to overcome those situations also, that how can we do without that also, because this problem is going to last for a few months at least from now. So we have to learn to live without oxygen also. And whatever we can do, we try doing that thing by adopting some innovative means and methods. But once the lockdown is open, I will go full blast on this. So make sure that whatever we have lost in the quarter 1, we are able to make up in quarter 2, 3, and 4. Hopefully, no such disaster will be looking forward to in the company. Maybe that COVID, that third phase also may be there. But then by that time, we will be gearing up ourselves to face those challenges and come out in a manner whereby we can still give to our investors a reasonably satisfactory result. That's basically the situation is. In quarter 4, that my total income has been 619 crores. For the year, it is 1720 crores. And we have made an EBT of quarter 4, we have done 32 crores. But because we have incurred huge loss in the quarter 1, which was almost close to 40 crores, the year-ending profits before tax is restricted to 11 crores 60 lakhs. So that's what the basically result of the company was. Now I'll come basically on the division-wise and would like to brief you basically how the company has basically performed in its various divisions. The first which I mentioned to you, there was the lockdown which was induced by the central government and which lasted for a month and a half. And thereafter, after the lockdown, the restriction which was imposed, whereby the factory was not allowed to operate, and we were only allowed in our factories to deploy 100 people. We employ nearly today in the factory 3,000 people. So we were permitted to operate the factories with only 100 people for a couple of months. As a result, gradually started building up the thing. We, as I mentioned, quarter 1 and part of quarter 2 was total washout. thereafter we started picking up. And in the given time, the performance, what we could achieve was, I consider to be satisfactory. And hopefully, immediately after this lockdown, we'll gear up again and make sure that our performance for the current year also is maintained on the same pattern. The performance of rolling stock division, which is the main division of the company, shown signs of recovery. Initially, it was sluggish, but then we showed signs of recovery. And we are basically thankful to the customers for showing their support during the difficult year by reissuing their deliveries, which was a real challenge because the commitment of delivery, which was there in the month of April, May, June, July, August, couldn't be maintained for the reason that there was no production. Now, nonetheless, once the pandemic situation improved and it opened up, we started delivering them and all those things. And as a result, under new schemes, private sector orders and things, it started coming to us also. Of course, there was not much, no fresh tender was released by Railway Board, which was overdue. But nevertheless, we relied on the private sector, and under new railway schemes, whereby they are encouraging a lot of private players to come in and get under various schemes, we are able to maintain our reasonable order book. We closed the year with the order book almost about 2,000 wagons, and we are also booking fresh orders. So hopefully this year also, there should not be a major challenge to our rolling stock division per se in respect of wagons. In respect of loco shells, there was a challenge. This division we started a couple of years ago. We have been doing reasonably well. But last year, because of, again, this corona period and the non-finalization of tenders and other orders, we couldn't get new orders. So we kept it low air. But by the end of the year, the inquiries started floating in. And when I'm talking to you, we have already booked order for more than 70 to be delivered this year. And hopefully this year we should be able to do much better compared to whatever we've done past, which was normally we were doing about 60-65 loco shells. The steel foundry division, in spite of that initial suffering and all this thing, covered up and basically maintained its performance. Of course, it faced challenge in respect of the prices of scrap skyrocketing, commensurate to the prices of steel, which was going up so high. And this has actually caused profit to dip. But then, of course, we are getting into the near areas, export and other fields, also getting into the defense field for hand molding casting through a new acquired unit of Ulla. And these things are basically making us to make sure that the steel foundry division we can run comfortably and profitably. The other area where we really suffered was basically our division in respect of HME and bridges. Now, this division basically more rely upon the site working. And the site working position basically has suffered only because simple reason that people at sites were not available. We all have heard about the immigrant problem and then how the immigrants went back from their respective place of work to their native places. And a big exodus took place at that point in time. And to bring them back to site and start working on all these things becomes a serious challenge. So this challenge we really faced in our HME and business division. Also, we faced the same challenge in our rail EPC division. Now, my rail EPC division also basically rely mainly on site working, and we have multiple sites where the people are working, and there are almost about 4,000 people who work on the sites. And these people, once they go back, it is very difficult to bring them back to the site and all these things. So we really face serious challenge in all these things. So to cover up that, we tried that best that whatever supplies we can make the supply. We also changed the pattern of our order bookings. So we went in the shape whereby we started booking orders for our core competency area of signaling. We booked orders in small your tenders where the volumes were 50 crores, 60 crores, like 70 crores. And those orders could be completed within 1 year where major course was supply and lesser part was of erection at site. So that's how we could manage some activity and we could show the performance which we have shown to you. That is, this division has done at almost 600 crores. So with this position, basically, the company has tried to make up its position. They did its best to make sure that even in the given situation, we are able to do something. So that's how we are doing in the rail EPC division. Now, in rail EPC division, we have another company called Bright Power. Bright Power, basically, we restrained ourselves and now we are focusing more on this because all these challenges has actually made my liquidity to really suffer. And because of liquidity challenges and all this thing, we were not going in for larger orders this last year. And we are mainly focusing on the smaller orders. So Bright Power division also now getting into the newer field of basically refurbishment, maintenance, and such areas where the time slot is less, and the margins are comparatively better, and the execution time is also short. This is requiring less amount of working capital. So that is what basic company has come to a situation where we have changed our strategy about this thing. So focusing more in rail division on signaling, we are focusing more on the basically auto fare collection division. Their supplies are greater than the site working, and to some extent our core competency is there in ballastless tracks, which we are maintaining. As far as the track laying is concerned, where basically it is very labor intensive, we have gone slow on that, and we have not booked any fresh orders as far as that division is concerned. So this is the rearrangement which we have done about in the company. Hopefully this will augur well for the organization, and we'll be able to balance ourselves. And with these submissions, I would like you to ask any questions which you would like to have in respect of operation of the company. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bhagesh Sagalkar from HDFC Mutual Fund. Please go ahead.
Yeah, can you quantify the current order book division-wise, and in the wagons also, the breakup of private and public sector? What are the challenges in wagon execution of axles and wheel rims, etc., and the outlook for margins, because steel prices and etc. have risen? So what are the key parameters over here?
Yeah, I'll give you the answer for the second part first. My colleague Hemant will give you the details in respect of the order book for various divisions as well as for the private and railway orders. Challenges, you rightly mentioned about, there are serious challenges because of the steel price and all this thing. The prices have skyrocketed. In fact, rather, the steel prices are up in 1 year's time by almost about 50 to 60%, which is unprecedented, never heard about. Fortunately for us, in respect to railway contracts, we have the variation clause. So we are able to pass on that cost increase back to the railways. So we are protected to that extent. In case of private parties, normally the order deliveries are shorter. They want deliveries within 3 to 6 months at the maximum. And as a result, normally they don't agree to giving you the price variation clauses. So most of the private contracts are without PVC clauses. We have the challenges faced by us. But as you all know, we have comparatively better margins in respect of private orders than the railway orders. So we are able to somehow sell through in those orders also. And the new order booking which we are doing, of course, that is being booked at the current market trend and current market price of the steel. So that way we'll be able to sustain, and there would be serious challenge on the bottom line as far as the order book is concerned. Hemant, now you can tell the details of the order book.
Yes, sure. Thank you. So the total order book as of March stood at 3,400 crores. So the breakup would be wagon division has an order of around 625 crores. My EPC division has an order book of 2,000 crores. My hydromechanical and bridges division has an order book of 375 crores. My steel foundry has an order book of 200 crores. My locomotive shells and other components has an order of 100 crores. Other subsidiaries and joint venture has an order of around 100 crores. In wagon division also, as Vijay said, that we have an order of close to 2,000 wagons. From Indian Railway, we have an order of around 275 crores, and from private around 350 crores.
So private book actually is bigger now.
Yeah, private is bigger.
Okay, and that's for the car carriers and application segments which they are ordering. And the private order book, private sector wagon order book is more better now from the logistics companies, etc., car carriers and all that things.
Yeah, it is basically, I'll explain to you, the private order books are basic. We were not booking because the price variations were getting so high and all this thing. Of late we started booking, and the order basically is now coming from all segments. Logistics, of course, is a major segment, which is giving the major order. But this apart, even the CTO companies are coming with the orders. So companies, basically, we are not buying the container wagons. They are also coming up for the orders. Industry is also coming in a big way. Be it SAIL, be it Ultratech, be it your NTPC. They all are coming out with the orders and all these things. So private sector, the customer base has become very wide. It is not restricted to a few particular segment of customers who are only buying. So that's a good sign in the wagon industry. Second part, which is important, which you would like to know about, that railway wants to treble the freight movement by 2030. That is what the railway's plan is. Today, it is almost 1.1 to 1.2 billion freight which is being carried, ton freight which is being carried. The railway's plan is to increase to 3 billion tons in another 9 years' time. So by 2030, that is the target of the railways. And to multiply this thing, of course, you don't require 3 times the population of wagon, but double the wagon population required. Today, the population is 2.68 lakhs of the railways. So naturally, railway will be looking for something, a population of almost 6 lakhs wagons. So it's a big, big market size. And railways, since don't have that much funds and all this thing, they will rely more and more on the private sector. And private sector, finding it very lucrative, are certainly getting into this thing. Like today, the iron ore prices are seeing a boom in the market. As a result, all the iron ore producers are looking for wagons to be available to them yesterday. So that's how basically the market goes about. But good thing about the demand in the wagon sector is now widespread. And it is in the variety of rail industries, not merely restricted to some open type and closed type, or otherwise restricted to container wagons or BTP wagons. Now, very variety. Steel plants are requiring the foil wagon, auto car requiring the auto carrier wagons, then of course, the fly ash required the fly ash wagons. So it is now commodity-specific wagons coming more and more in demand. Of course, they were there earlier, but not in that volume, which volume is now looking to. So it looks like that this segment should do well in the coming years. Thank you.
Okay, thanks.
Vijay, this is Indrajit Mukherjee. I just wanted to supplement your very well articulated answer by one more point, is that there are lots of work going on in the company for improvement of internal efficiency, which really works out to reduction of wastage, quicker productivity, get it right first time, TQM, etc., etc. So I thought that I'll just mention that.
Sir, thank you so much, sir.
Yeah, thank you, sir.
Thank you. The next question is from the line of Kirti Jain from Sundaram Mutual Fund. Please go ahead.
Sir, when you say that the demand is improving, in the previous cycle, we saw that company can clock as high as 18 to 20% of margins. So when do you expect such golden days back for the company, sir? That's my question.
I would love to have that situation, and we all are waiting that kind of situation to emerge, whereby we can make and give that those kind of returns to you. Of course, it will take some time, because you see this particular segment have been battered in last couple of years. No orders from railways, order coming at highly competitive prices and all these things. So segment was badly battered, and now situation is gradually improving. Of course, when the demand is good, the market is looking up, then you will find that industry cannot suddenly increase its capacity to supply a substantial quantity. But the prices also start improving, and that we are going to see that in coming future. Maybe that we may have to wait for one more year to come to that situation.
Sir, there were earlier predatory pricing, like we used to hear Jupiter, Amtech, all those names creating predatory prices below cost and all. Has the situation gone off completely now? Is the pricing now relatively better? How will you describe the pricing, sir, now?
I won't say completely, but just like Amtech. Amtech has gone out of the business because they have lost heavily on this. Jupiter, of course, they initially were doing quite predatory prices and all this thing, but today they have changed that strategy because they have become also an established supplier. So they don't need to do that predatory price to get the business. They are also getting the business. And the kitty is large. Everybody gets the business. Why should one go for predatory price? Predatory prices come only in situation where the kitty becomes very small, and everybody wants out of that kitty their major share. So this situation is likely to be changed, and with more and more opening up to the private sector by the railways, situation will be different than what it used to be earlier, when companies were merely depending upon the railway orders.
Okay. So what would be the industry utilization, maybe something like in the Q4 period, sir, roughly?
I couldn't get your question very clearly.
Sir, what would be the industry utilization, capacity utilization in Q4 FY21 for the wagon manufacturers?
See, ultimately, we have been, if you see the history, wagon manufacturers, the maximum have produced 18,000 wagons in a year. That's what basically is going about, excepting for one exception year when the production was almost about 19,000 something. But never they have made more than 18,000 numbers. Now, gradually, earlier, in last couple of years, the capacity utilization was close to only 10,000. It has now gone up to 12, 13,000. And hopefully in the coming years, it will again start looking at 18,000. Once that kind of segment emerges, the prices also start showing signs going northwards.
I asked Q4 because in the first 9 months, the business would have got disrupted due to COVID. That's why I wanted to check with regard to Q4. Are we able to come to around that 4,000 to 5,000 range as a quarter? On annualized run rate, are we able to come to that normal level?
Not in this year, let me be very clear. Not in this year. But yeah, coming years, we are targeting that.
So by FY23, we should see, sir?
Hopefully, the way the business is going and the segment is looking up, hopefully we should be targeting that kind of situation.
Okay. So last question from my side. With regard to our EPC and other construction businesses, so what are the kind of credit controls and other controls which you are bringing and implementing in the systems to improve the profitability and smoother execution?
Very interesting question. Rather, I wanting to look forward to reply this question for anybody coming to. See, earlier when we went into this business, we went into main three segments. Signaling, which was the core strength of the company, ballastless track, and track laying. Track laying is a business where volumes are very large. And of course, we wanted to make a top line, which is basically commensurate to the size of the company. But execution of those depends on a lot of factors. And it is highly dependent upon what the government policy from time to time remains. We burnt our fingers by coming across the policies of the government, whereby the government has put even the mining of the land into restricted areas, restricted zones, and moreover, this business is totally controlled by the local mafias. So these challenges, it came on the surface, we faced it, we realized, and we found that maybe this is not our line of business, we being a core competency company, so we'll remain in the core competency area. So this year, if you see, we have not booked any order in rail EPC business in respect of track laying. We are focusing signaling, and we have booked almost 300 crore order for signaling in this year. And signaling orders are faster in execution. Money is not blocked. The liquidity is good. Your working capital flow is evenly maintained. Unlike areas where we are doing a couple of your track laying contracts, both in the segments of export as well as the domestic market. The challenges which we are facing in this respect is Bangladesh, we are doing a major contract. Now Bangladesh's border is closed. We are not permitted to enter Bangladesh. And it not happened once. Last year it has happened 4 times. Resultant thing is this thing, our resources there are idling. They are not able to execute the job properly. The money remains blocked because unless you reach the milestone, the payments are not being released to you, or even the payments are released partly 70%, 30% money remains with them. So this kind we see that the working capital blockade is very high, and other divisions of the company start suffering for that. So that is why the strategy-wise we are now focusing more on orders which can be executed faster and where the site gestation period is comparatively smaller. So that's how we are focusing signaling, AFC, and ballastless track.
So just clarification, sir, anything quantitative thing can you give on the Bhagesh ji last question, sir, like what he asked on the number terms, what we want to achieve in FY22?
You know, I generally don't predict on all this thing, but it will certainly be better than what we did the previous year. That means year 1920.
Also in terms of margins, sir, margins also will be better?
Margins, certainly it will improve compared to what we have been doing. it will improve because the demand segment has positive.
Sure, sir. Thanks a lot, sir. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Shyam Sundar Sriram from Sundaram Mutual Fund. Please go ahead.
Yeah. Hi, sir. Good morning. Thanks for taking the question, sir. Sir, just one additional question. I think my colleague asked quite a few points, and thank you for all those clarifications. Just one additional question, sir. As we look into F22, the fiscal year 22, sir, from a wagon production perspective and for the railways, do we see this 10,000-11,000 number of wagon production a year going meaningfully up to 15,000-16,000 this year itself, or we think it will be at the same 10,000-11,000 wagons a year? What are your thoughts, sir?
If you want my gut feeling or my limited knowledge in this field, which basically I could gather from this thing, my instinct says it will be closer to that.
Okay. Is this because of this 2 months lockdown, etc., or is this the general ordering momentum is that pace?
You got me wrong. My response was basically it will closer to about 14,000-15,000. So it will see the increase.
Okay.
In spite of the all closures and all this thing, the demand is such, it will see an increase.
Understood, sir. Understood, sir. Thank you very much, sir. I'll fall back in the queue. Thank you.
Thank you.
Thank you. The next question is from the line of Kaustav Bubna from Rare Enterprises. Please go ahead.
Yeah, hi. Sorry, I missed the initial part of the call, so I apologize in advance if I'm repeating something. So I basically wanted to understand, very bluntly, wanted to ask, a lot of money is being infused into the company at these price levels. So I wanted to understand, how much of this infusion is going towards debt repayment and working capital management versus how much of it is more towards the promoters' bullishness on the business going forward. Could you explain what, you guys are so bullish about going ahead in like the different verticals and just explain that properly?
Sure. See, Texmaco is a flagship company on the globe and one of the premier engineering companies which has withstand all the onslaughts which has happened to engineering industry in India, especially in the eastern zone, and one of the very few engineering companies which survived all the turmoils during 60s, 70s, 80s, and has emerged stronger over the years. Promoters have tremendous confidence in the company and in the basic USP of the organization. So, promoters have analyzed and found it convincing that yes, company needs liquidity for the reason that because we went into a business of rail EPC, Kalindi, where the deployment of working capital was substantially larger than what we could have anticipated. Due to the reason of COVID and other factors emerging and all this thing, and last year we were incurring certain losses and all this thing, banks were also not coming so favorably to increase the limits. They were restricted lower limits to the whatever limit levels were there, and we have to bring in some money to make sure that the working company is not getting impacted. So promoters decided to put in almost about 170 to 200 crore rupees in the company, and that is how, if you see last year, the window available to promoters to go ahead by infusing capital by way of preferential allotment to the promoters, we utilized that window. So initial window was for when by the time the permission and all came, we put in 79 crores, but due to technical reasons that balance money could not be brought into that particular time limits. So we have to go again for that thing. We went again, but some of the fellow shareholders, they thought the promoters are enriching themselves with additional equity of the company by and not giving opportunity an option to the other investing public to participate in this thing. And in general, we got a feel that they are looking more for a right issue than for promoter getting for a preferential allotment only. So promoters, the feedback promoters duly analyzed, and they have very generously agreed to the suggestion. And in the last board meeting, they approved to go ahead with the right issue up to an extent of 175 crores. That, of course, the quantum will be decided by the capital committee, which has been formed for the purpose. And once they meet, they decide the size and all this thing. Will be coming with the right issue. very soon in the market. So that's how promoters talk. Why the confidence promoter is there? Because the segment is looking, as I explained in my initial phrase, you might have missed it that point. We have mentioned that how the railways are targeting to increase the volume of the freight. I didn't mention that one thing also, the railway target today is from 29% market share of freight to increase to 50% market share. And they also want to move the traffic from 1.2 billion today to 3 billion by 2030. So this all segment looks for that the railway requires these products. The railway has to move the cargo through some means. And they require
this would benefit your rolling stock division, right?
That's right. And in the EPC, in the last question, your fellows from Sundaram, when they asked me, I clearly answered to them also. That's what we are planning for EPC. We are going ahead more in the niche segment, which is basically signaling, AFC, and ballastless track, and not focusing ourselves on track laying, which is high volume, but it is unpredictable. And involvement of working capital become very large. So we have accordingly decided that yes, our focus will be in a different zones.
Okay, that's nice, but wanted to so if you include conversion of loan to equity, preferential and rights issue, which is the series of events which have taken place, right, one after another, what is the total dilution which is taking place, or would it be expected to take place?
I really don't know what is the size of your right issue will be, but as I told you, 79 crore already induced in the capital. 175 is the board approved maximum limit for right issue. Depends on capital committees at what size they will like to come with. But apparently it looks like minimum 200 crore company will be getting out of this.
Okay, and also two more questions. One on your receivables. So could you just explain what the 600 crores receivable? Could you break up who are these receivables from, the 600 odd crores, and what the status is, confidence of receiving the money, and what the reality of the situation is?
See, most of these data are basically from government parties. So the confidence level of the company that way is quite good. Some of them are also from the large private sectors, especially the big conglomerates. And therefore, one of the reasons the payments, because mostly payment is stuck in our EPC business. Otherwise, in other businesses, all this payment cycle is generally good. And in wagon industry, payment cycle is basically maintained reasonably by all the players, whether be it the railways, be it the private sectors. So that some payments are there, that disputes, that challenges which we face in respect of final realization, as I mentioned initially, that 30% of the payment comes from the milestone achievement, and the gap between them, that is the where our money gets stuck. We are working on that direction. So two specific areas we attack. Number one, by not going into the track laying work, we are reducing the volume of our unbilled revenue, and by making sure that as we are taking the smaller value contracts, completing in time and getting out of this, we are also reducing our debt liabilities. So basically, if you see today, my debt and all these things size-wise, it has not gone up. In spite of all this difficult period of COVID, people not being paying and all, my debt limits are almost at similar levels.
A lot of
people are going down.
Sorry, what?
My debtors level is almost the same level. Their inventory level has also gone down.
So, a lot of people who track a lot of analysts who track your company and the sector are of the opinion that this DFCC increasing freight traffic, etc., through rail story has been going on for years, but it hasn't really benefited the company in any way. So what do you have to say to that or about that?
The main reason which I explained to you basically again, the business is such, especially the track laying thing, where basically only the larger players, small, will be sustaining, who are doing the civil work together along with this thing. We are not in the civil work, and we are facing challenges in respect of whether for one or the reason, if any particular constituent is not able to complete or fulfill his obligation, we are getting stuck and our money gets stuck. And we are not so today comfortable situation whereby we can deploy unlimited working capital into the project and wait for this thing and go against claims and all these things. So that's not the policy of the company. Accordingly, we have decided in such kind of projects, we will take lesser interest and we will more focus on the areas where competencies are good and we can get out very faster. So this is the trend change which we have taken decision, principal decision from this year.
Yeah, no, I was trying to understand more on the rolling stock division. On the rolling stock division, which you were saying would benefit from increased freight traffic, right? You were saying. Could you explain a little bit as to when that will actually start showing in your numbers and how so?
I answered that question when the query came from SDSC. I answered that in detail.
Okay, so I'll go back to that. Okay, great. Great,
Right.
thank you.
Thank you. The next question is from the line of Nishit Shah from Equitas Investment. Please go ahead.
Good morning, sir. Most of my questions are answered. Sir, I just wanted to understand post Q4, are there any significant order wins in any of our divisions?
Significant order intake.
Yeah.
Yeah. Hemant, can you answer?
Your question is post Q4.
I'll answer that. Don't worry, Hemant. Post Q4, we have been able to book orders in wagon segment. We have booked orders for 400 wagons in wagon segment. And in respect of rail EPC, we have booked order for about 180 crores in signaling division. In my electrification, we have booked order for almost about 30 crore rupees, but that is basically in the new segment of refurbishment and maintenance, which is normally high return, and that is where the focus of the company is today. So that is there we have booked those orders. In foundry and all things, we are booking regular orders for export and all this thing as usual. There is nothing which is basically significantly any big jump or go down. The positive thing is this thing in foundry, we are now approved for supplying to defense, and we are supplying to naval, the large castings, casting weighing up to 22, 23 tons, individual castings. We are supplying to naval, and which have been well received, and that is comparatively better remuneration which we get on that. So that's how basically the orders will trend, and we are comfortable with this thing. The inquiries are many. We are working on them selectively also, and also basically going in the area because our competency is mainly in the specialized wagons, and that is the area where we are really focusing upon certain new developments as well. And we will also cover this point in our concluding remarks. Thank you.
Division, what would be our capacity utilization?
If you truly see capacity, we have capacity to build 7,000 wagons also. But then it depends upon what kind of types of wagons we get and what types of wagons in a particular run we get. So these are very flexible ones. But today, roughly, we are, if you see on an average, with the mix of all the wagon and all this thing, we are running hardly at 60%.
Yeah. And sir, I want a clarification. So you said 625 crores is the order book for wagon segment, and Indian Railway is 275 crores out of this, right?
Yeah.
Okay. And sir, lastly, can you give me dispatch number for wagons for the quarter?
Yeah, for quarter 4, the total number of wagons. Hemant, will you please speak out?
Yeah, sure, sir. So for quarter 4, the total wagon dispatch was around 550 wagons, of which railways were 300 and the balance were for private. Hello?
Yeah, sir, I'm done. Thank you.
Yeah.
Thank you. The next question is from the line of Dinesh Kotecha from CRIC. Please go ahead.
Sir, good morning to all of you. Sir, failure is not falling down but lying down. And you have said that you have got the resilience to sustain and survive and grow in the last 7 decades. Now, my question is, going ahead, what are the likely bumps that you're going to face and what is the strategy to growth? And can you give me a spot of failure actually? And what is being done internally to avoid that now?
We'll cover this in our closing statement in general. We cannot be very specific, you know pretty well these questions, but we'll certainly cover in our concluding remarks what is the vision for the company.
And sir, about the rights, what is the rights that you're going to be taking?
Right section, let capital committee decide on this thing, but the size of right capital will not be more than 175 crores. That is where they are working on this thing. And Ravi, would you like to add something on this?
I would like to know, what is the internal activity of cost reduction that you are now focusing on?
Yeah, that is basically as the MD explained in his short remark in one of the questions, an answer to one of the questions, that we are working both on improvement in our utilization of the material, so better planning for utilization so that the wastages are reduced dramatically. Second thing, our component manufacturing and other areas where can be improvised, whereby the cost can be reduced instead of depending on the outside sources. If from the spares or of the scraps which are emerging out, we can prepare those components and all this thing, and in-house we can do that thing. And also that improving the technology whereby rework on these wagons are totally stopped, or rather fabrication what we do is totally stopped. And certainly that all depends upon the quality improvement, which is the core area of focus of the new team. Thank you.
And the recovery of the stuck-up debts, I mean, how is the progress going on there?
Yeah, that also explains the last question. The recovery of debt, basically, if you see that my debt level, in spite of difficult times, we have maintained the same. The debt has remained the same levels, and gradually we are trying to reduce it also. We are working constantly on this thing. Last year, we have been able to reduce our inventories to a large extent. This year, our target is to reduce the debt to a large extent, and that will happen because the moment we start achieving the milestones, the debt and unbilled both will start coming down dramatically. That is what the focus area for the management is, and that is what management has taken task on its hand.
Thank you, sir. Wish you all the best.
Thank you.
Thank you. Ladies and gentlemen, we will be taking the last 3 questions. The next question is from the line of Siddharth Bodha from Principal India. Please go ahead.
Yeah. Good morning, sir. Sir, regarding this debt, regarding this debt reduction, sir, can you please help what will be our target for FY22 and 23 X of right?
See, ultimately our target is this, that the debt and unbilled revenue, it should come down to the level of maximum 3 months. That is our target. 3 months of our turnover should remain between these two items. That is basically we are working constantly on that, and hopefully we'll be able to achieve with the change in the business track, which we have now basically decided.
Okay, sir. Okay. And sir, regarding this railway EPC, so you have mentioned that there has been some change in the product and all. So 2 questions on that one. Number 1, so do we have any legacy orders, so that is going to again hamper FY22 or 23? And second, with the change in the product mix and all, so what can be the reasonable margin and the working capital in that particular sector?
Can you come again? The first question I didn't get clearly.
Sir, any old orders that is there in the EPC business, which will attract the higher working capital and the low margins?
There is, I must admit. Number 1, this question I have divided 2 parts. 1, the legacy contracts, of course, we have left them behind, and that's basically only the residual ones, which is basically the final 5% and 2% and 3% like that things are there, which we are closing down, and this year our target is to at least close 18 contracts. Second point which is there, do we have such contracts which I was talking about, especially in the track line? We have. One of the major such contract is EDFC. The second one is basically Bangladesh. These are 2 major contracts where we're doing the track line work and all this thing. So there the challenges are still there, but hopefully once the situation normalizes, and the larger value of contract is Bangladesh, where we have substantially large value of contract. So that is what basically we'll be gearing up and posting our team there. So that, but in case the pandemic remains such, then that can certainly be a challenge in the coming year as well.
Sir, I'm just talking about as and when the things have become more normal. Sir, by when?
Domestically, we are closing down all the contracts. The one contract with EDFC also will close in this year. This apart few smaller which remaining things are there. We are targeting to close within this year. The only thing which remains large value is Bangladesh, and where if the pandemic situation is not there, certainly we'll be able to move faster because Bangladesh working compared to the Indian condition, all these things like mining and all the restrictions and all are not there at this point of time. So hopefully that will not be a big challenge, and if the sites are available to us, we should be able to do. But that is going to be completed in next 2 years' time, this year and next year. So by 23, we should be able to complete that contract as well.
And sir, that particular contract, Bangladesh, as you correctly mentioned, is a large order, but that will pull down our working capital and the margins. So whatever good work we are doing actually in the remaining part of an EPC, that will be
not only Bangladesh, I think will be able to regain a lot because basically they have delayed the contract because they changed the design. As a result, our resources have idled there and the cost we already booked. So those things I think we'll be able to get the adequate compensation from them. But it is basically in general in all this track laying contract, these typical problems are being faced. If any constituent of the contracts in the overall scheme of things are not able to do their job, we get stuck. If the bridge is not made, we get stuck. If the land is not filled, we get stuck. If the land is not basically stabilized, we are stuck. For one other reason, we're getting stuck. So that's the way they may be problem. As far as signaling and electrification is concerned, these problems are not there because we are going on a developed sites, which are already tracks are already laid, earthwork done, bridges done. Then only we come into picture. So that kind of situation basically helps us, and that is the focus of the company now we have realized, and we are accordingly changing the business track on that.
Correct, sir. So you have mentioned in your previous answer. So my question, last question is on the EPC business. With our new the focusing on the electrification and signaling, what can be the margin that we can expect from that particular vertical, and what will be the working capital if we stick to the signaling and the electrification part?
I won't, that I don't speak about margins in this because this is a forward-looking statement. I restrain myself from saying anything. But the segment where our core competency is there, which are three, which I analyzed to you, of which two are our core competency and third we are developing the core competency. In signaling, it's a niche business area. We certainly have better margins. In your brushless track, we are the leader in the segment. As a result, we are able to get reasonably good side business and large businesses and all these things. The margin is normally, other than some variation here and there, is reasonable over there, that we don't face much challenges in the margin there. And ASU is the new field which we are getting into. We have done a couple of jobs, and now we are also getting to export this segment into big, where major part is supply, lesser part is basically site working on. So I hope that with these three segments working together, certainly the margins of the rail EPC division will look up. And in electrification, as I mentioned, our focus today is now getting into the more to refurbishment and maintenance, which anyway compared to the new supplies are the higher margin business. So that's how we feel that yes, we'll be able to attend to the margins also. The challenge which we face in margin also will be able to attend.
Correct. So my last question is that the industry leaders, those who are doing the signaling, EPC and electrification work, they are doing an EBITDA margin of 10% and working capital days of 90 days. So are we near to those metrics?
Not near to that. Our margins are certainly better. In electrification, we have been working at EBITDA margin of 14% to 17%, depending upon what kind of business we have done during the year. Your Kalindi segment, we have been working at the EBITDA margin of 13 to 17%. Of course, over the period, our margins have gone down, and because of working capital involvement to a large extent, a major portion of that is eaten up by the interest segment. That is the focus is this thing, that how to reduce that working capital burden. And as I mentioned, my debtors are unbilled. We will try to bring our target to bring them down to 3 months level, which will certainly make me rotation my working capital much faster. And resultant thing is this thing, my cost on interest certainly will go down, and that way my net margin will improve on that.
Okay. So as you clearly mentioned that we are targeting like 3 months working capital for the entire company, so that will also be.
I didn't say 3 months working capital. Basically, I was talking about unbilled and this thing. And rail EPC, basically, there is no inventory. So per se, rail EPC is correct, but in case of brick and mortar, this is not correct.
Okay. So that was helpful, and hope so you can conduct the call on this on a regular basis so that we can have a connection and the continuity.
Yeah, my MD also wants that, so I'll do that.
Thank you, sir, and best wishes for upcoming quarter.
Thank you.
Thank you. The next question is from the line of Arvind Joshi from Battalion Advisors. Please go ahead.
Yeah, hi. You answered my question, which I'm going to ask in some parts. I just wanted to have a more broader and long-term understanding of your thought process. What has been the learning from the tumultuous year we just spent encountering the COVID issue, the pandemic issues? A lot of companies have reinvented themselves from this pandemic. Any learning that we can share with us and also highlight how we can transform ourselves in that, and any new strategic positionings that are going to emerge because of these experiences? I just wanted to understand that, and how will we enhance our competitive positioning based on our past learning. Thank you, and all the best.
A very good question, rather. Especially to our kind of company, this is a very, very pertinent question. we, as initially I mentioned, that we are a 82-year-old company, and with being a 82-year-old company, we are basically considered to be a traditional company, laggard in certain aspects and not induced to the modern technique and all these things. But with our younger team, which is there in place today, and we first time we learned that today we can, in fact, rather, I'll go a little background. We were having offices and corporate office separate and plant offices separate, corporate office working from city and the plant office working for plant. And then we decided that, okay, this is not very fruitful and effective. If the plant offices and the corporate office are combined together in the plant itself, the efficiency will improve and the decision-making process will certainly go much faster. And that is how we did sometime in 80s. Now today I'm realizing that everything is locked down. There has been situation whereby people are not able to attend to office. The transport facilities and all these things are curbed by the government. Regular restrictions are being brought in. And still we are able to work very effectively. And today work from home is normally becoming a culture in our kind of company as well. So which is very, very interesting. And this is the first learning we had. It is not necessary that the offices should be very close to the place where we work. We can work from anywhere. It is more important thing, the strategy and planning which should be done, and that can be very well done from the way we are now doing for last one year. More than 1 year, rather now it is 13, 14 months. So that is what basically learned. Second thing we learned about this thing, that our production processes were such where we're targeting that we cannot get into production lines unless we have make sure that all my jogans are properly manned, all my materials are properly available at site and all this thing, and then the production line starts like assembly line. Today we have changed. If one jogan is not working, we skip that jogan, get into the next jogan, work this thing. We're working with a smaller group of people to make sure that at least some operation goes on in spite of restrictions and all. I'm sorry. And all the kind of bottlenecks which are being faced by us due to these restrictions, COVID and various government restrictions whereby my component suppliers and all facing challenges. Some tidbit items for which earlier the production used to stand still and all things we are doing in-house, making sure that if something is not come, adopt an innovative way, do it in-house, and make sure the production line keeps going on all these things. So these are the new learnings which we have got, and that certainly is going to make company much more strong and strengthened in the coming period. And this certainly will add a lot of value to the organization, basically.
Thank you. Thank you. Thank you so much, and all the very best to you.
Thank you.
Thank you. Ladies and gentlemen, this will be the last question, which is from the line of Deepak Rajni, an individual investor. Please go ahead.
Yeah, good afternoon. I have a quick question on the rights issue. This is the second time you have announced the rights issue. I'm just trying to understand why is it that you haven't yet set out the terms of the rights issue?
My colleague will answer to you in detail about this. Ravi, I think this is a question you should attend.
Yeah, thank you, sir. Sir, well, I would like to address a query on the right issue. See, the right issue terms, the board has approved, a limit has been already approved. The board has approved up to an extent of rupees 175 crores. Now they have left the option to the capital issue committee to decide the terms, condition, including pricing, based on the situation, which the committee will take a call, and accordingly the information will be made available to the public and the stock exchange as well.
Sir, I understand that. My question is, you guys announced the rights issue this is the second time the same announcement has been made. You have announced the rights issue in the past. It's been aborted for reasons best known to you all. Subsequently, you have announced another rights issue, and then we are hearing a rather bureaucratic answer that there will be a capital committee. Why couldn't the capital committee meet and then decide the terms? What are you all uneasy about? You are unable to sell 200 crores worth of paper. What is the difference about?
Yeah, I'll answer this question. Ravi, I'll answer this question. Yes. See, your answer to your first question is very clear. The last time we have very openly and clearly disseminated the information that the board couldn't, the company couldn't go ahead with the right issue for the reason that the approval from the NSE was, BSE took it's much longer, and finally we could get the approval only on 26th of September. Whereas the opening of issue was not possible to do within 29th of September, which is last date. So resultant thing is this thing that issue has to withdraw. And we went for further. Since that money company required liquidity much faster, the promoters came forward and said that we are willing to put in the money by way of a preferential allotment. And that is how we went for preferential allotment. Once that approval came, promoter put in 79 crore rupees. The balance thing, because the technical reason couldn't come in that point in time, we went again so that the last year itself the preferential allotment money could come. Somehow the shareholders were not very comfortable with that. The opinion of the general shareholders was this thing that instead of preferential allotment it should be a right issue. And as a result, they didn't pass the resolution at that point in time. And getting the feedback, we put in the last meeting about this thing. The capital committee certainly meet, but pretty well times are difficult and all this thing. People are not in the site. There is a complete lockdown situation. Immediately post-lockdown, when it is open up, our capital committee will meet and come forward because we want it to come very fast.
Sir, I completely appreciate what you're saying, and kindly bear with me. My question, you or your colleague just spoke a couple of minutes ago about how you are well adjusted to working from home right now. The lockdown certainly can't be a reason why senior management can't decide the terms of a rights issue. That is not something that needs to be met at a physical environment. The short point is that having had an aborted issue, one would expect that the management would be prepared and be ready with terms rather than announce that you are raising 175 crores and then a capital committee is going to meet to decide the terms of the issue. I mean, just think about it.
I need to intervene into this thing. I think correct. You see, no board decides on the terms.
80-year-old multi-decade-old company that is struggling to raise 175 crore rupees, or maybe are not struggling. Certainly it appears like that. If over a period of little over a year, you'll have announced an issue for one or the other reason, not being able to fulfill it. Sir, the capital market is functioning seamlessly through the lockdown. People are raising capital, IPOs are happening, all kinds of stuff is happening. You guys are taking more than a year to raise a sum of 200 crores.
No. I don't take your argument, and it is not well conceived argument you are making. Please try and appreciate and understand what I explained to you.
Sure.
This 1 minute. This has been approved by the board on the meeting of 14th of May. Unfortunately, immediately thereafter, complete lockdown was there. It is a disruption. Please appreciate in all this thing. We certainly are going to organize the capital committee meeting to make sure the terms are finalized and issued to this thing. But disruption, we have to now basically first finalize your merchant banker, then the legal entity and all these things. We have already finalized the legal entity. Merchant banker, we are in the process of finalization. That also will be finalized within maybe by early next week. Immediately thereafter, they will set the terms and all these things, which will put to capital committee, and capital committee will make sure on that basis. It is not that the same terms and conditions which last time was put will be acceptable to shareholders. Shareholder would certainly like that this time and the next time again we are coming with this issue, that terms and all should be slightly different than what this thing. Then what should be the pricing? These all things need to be worked out and accordingly decided. We are not taking much of time, but of course there can be a couple of weeks time which we will require to do these activities, which we certainly are working on this thing. And I don't think your basic approach to this thing that the company is struggling to raise is correct. If the shareholders were not willing to allow company to raise through the promoters' preferential holding, that's certainly a prerogative of shareholders. But then doesn't mean that the company is not in a position to raise the money. The process was different.
I'm not saying that you're not in the position to raise money. All I'm pointing out to you is that it's been, I don't know, 15 months. I don't know how long the specific period of time. It's been inordinately long, and the company has been unable to conclude a capital raising, an activity that any other company, any other reasonable company is, that part of financial activity has not been impacted by the pandemic. All I'm trying to say is that shareholders, minority shareholders, have been, the outcomes that we've been living with for multiple years. There has been extremely poor financial performance, therefore extremely poor return, metrics for minority shareholders. And in whatever your argument may be, sir, the cold facts are that it has been more than a year and the capital raising has not been concluded. And my short point was, given the problem of the previous episode, I would have thought that you would have been prepared and come with a capital raising plan with all aspects covered, not a capital raising plan which is announced and then you will go and decide the terms. Sir, we are both pulling in the same direction. I have the same interest that you have, which is to see the company do better. But I am struggling to understand how you don't see the message that you're giving the capital market by taking 1 year to raise 200 crore rupees.
That 1 year.
There's a message going out to investors at large that a multi-decadal company cannot sort out capital requirements in over long periods of time. And I urge you to take this, constructively and try and change and the messaging that you're giving the market. It is not a coincidence that the stock price is languishing. It is these actions that are causing this kind of price behavior. So kindly.
1 minute. I think you are what your subject you are going about. You are not trying to appreciate and missing. You are harping on that 1 year, 15 months, and all those things. Company has come out very clearly every time why it has not happened, and those are basically technical reasons where we have company management has no control. Please appreciate and all these things. This time, what you mentioned, correct. Board never decides about the terms and all these things. The board basically first principally has to approve whether they are willing to permit to us to go ahead with the capital issue. They have permitted us on 14th immediately thereafter. I told you that lockdown, so they're a little upset of the working and concern and all this thing. We have already in the meantime finalized the legal advisor for this issue. We are also working on the merchant banker. Immediately we'll finalize the merchant banker in the coming week itself. And thereafter terms will be put to capital committee and get it approval done and come to the market. So please appreciate. I do understand that, but your pains I understand. If the market is languishing, the share price is not giving good returns to the shareholder, certainly there is a pain.
Sir, sorry, I agree. That pain is there. I'm not denying that. But that pain is not something that you are responsible for as an executive team. I'm saying something else, sir. I'm just trying to, I hope you get a constructive message from what I'm saying. There is a signal, sir, there is a signaling that, of efficiency or lack thereof, when you conceive a plan and execute it in a timely manner. And when that does not happen for a long period of time, the market perceives it in a certain way. You must take that signal from the market is my point. See, the pain may be caused is not only caused by the absence of the right issue. The pain is caused by a multiple set of reasons. Other competitors are also feeling the pain. I understand that. But I'm just
I appreciate your point. Your point is also well taken. I like to, because I owe you an explanation. That is why I gave you that detailed explanation.
Fair enough.
Certainly, it was very important for me. And I take your point, and we will discuss internally with the management team how fast we can do this thing and come back with our terms condition for the right issue.
Appreciate it.
And that's for the recording. Verify that the date of approval of the board was 15.
15. Oh, so I'm sorry. I mentioned wrongly. It was 15. Yeah. The last day of our working. Am I correct? Sorry, that was the last day of working when the lockout was declared?
On 15, while the board meeting was on, we got to know about the West Bengal government notification.
Yeah.
Immediately on the next day. So, well, now I think we can move on if there is no question.
Thank you.
Now, I think all the questions are over. And maybe the MD would like to say something.
Okay.
Yeah, I am available here. It was very nice to go through all the questions, and more the questions are coming. I was thinking that most of the questions have, including the last one. Of course, the gentleman was very agitated, maybe for fair reason, but all these questions only help us to improve and look into various other areas to improve, because that's why we are here to add value to the corporation, so that the shareholders can enjoy the benefit of the same. So some very interesting questions came, and one of the questions I just can't help but addressing to is what you are doing in the lockdown. And I think the lockdown, my way of looking at it, that is allowing the management to innovate more and more. And I think what has really happened, that we have thought through the various ways to improve, what more we could do. Like, for example, there is, I think Vijay has already mentioned, it's a company which is like human body. The engineering companies depends on metal cutting and metal fabrication and no oxygen. So how do you operate? without oxygen. It's a great example of innovation. So it also gives us time to innovate. It gives us time to look at our future. It also is strengthening our internal actions, because right now we are on lots of internal actions and how to improve our efficiency, how to reduce the cost, how we have the best kind of product in the market, how you develop product which is going to be coming in very soon. So how you are actually ahead of the curve. And that's where the design teams are working. So these are the various activities which are going on. Maybe we have faltered. Like the gentleman just now said, you have faltered, you have not taken your time for deciding how the capital issue should be. Yes, that's an important point. Maybe we haven't done it, but thank you for pointing it out. But at the end of the day, I see a very, very strong future in the areas where we are working. And we also, our mind is very clear where we should focus instead of being a wall-to-wall carpet. And Vijay has very clearly articulated that where we should be, where we should not be, how we should work internally, both in the production of rolling stocks, in the foundry, as well as in the EPC contract, where we are completely changing the way we want to work, including the bright power. So I think, in a nutshell, the questions were so good that it gave us more chance to think and introspect and improve ourselves. I think that's all I have to say.
Thank you, sir.
So anything more, Naresh or Naveen, anything more, or should we?
No, thank you very much, Mr. Mukherjee and Mr. Vijay. Rituja, please take over.
Thank you very much. On behalf of SKP Securities Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.
Thank you.
Thank you. Thank you, everybody. Have a nice day.
Thank you.